Get out! And hopefully you're going to have some fun learning. So as I said, we're going to look at adjustments, something called closing transfers, and financial statements. We're going to do a pre-adjusted trial balance, or have a look at a pre-adjusted trial balance. It's normally the starting point in test questions like this. Then there will be adjustments, more on adjustments in a short while. And then after we've done the adjustments, you might be required to draw up a post-adjusted trial balance. Post means after. We'll look at closing transfers, and after the closing transfers, we do something called a post-closing trial balance. See, that's a post-adjusted after adjustments. This is a post-closing trial balance. So a post-closing trial balance is done after closing transfers, and a post-adjusted trial balance is done after adjustments. Then there's something called final accounts, a trading and a profit and loss account. And then also in this section, you're going to draw up financial statements. You will see them at the end of the video. So this video is just an introduction to adjustments and year-end procedures. Just to paint a picture, you've done transactions that were recorded on source documents, they went through a journal, then the information was posted to ledgers, and reconciliations were done at the end of the month. Now you're at the end of the financial year, and you have a pre-adjusted trial balance, which is your 12th trial balance of the year. And at year end, we are going to do something called adjustments. Then, like I mentioned, after adjustments, there's a post-adjusted trial balance. So you have a pre-adjusted trial balance, adjustments are done, a post-adjusted trial balance, then there are closing transfers and final accounts to record the gross profit and the net profit. It's the trading account and the profit and loss account. After that, all the N accounts have been closed off, all the nominal accounts, income and expense accounts, and you can draw up a post-closing trial balance. In a post-closing trial balance are only real accounts, so assets, owners' accounts and liabilities. Sounds a lot like a statement of financial position. And then after that, we're going to draw up, and you might know it as an income statement, but statement of profit or loss and other comprehensive income is the modern name, and a statement of financial position. So there's quite a bit in this section that we're entering into, financial statements. Later on, there's analysis and interpretation of the financial statements. So that's where we are. And then also that just popped up there, but we might look at a statement of changes in equity, which is quite simple. So adjustments. What are adjustments? Why do we do adjustments? Adjustments are transactions done at the end of the year, our financial year end, to truly reflect the financial result and financial position. The financial result is the profit, and the financial position will tell you what the owner is worth, the stake that the owner has in the business. Remember, we're still dealing with the sole proprietor, but whatever form of ownership you do deal with, adjustments are done at year end. So according to accounting principles that guide financial reporting, our financial statements should fairly represent the results and position of the business. So that's why adjustments are done, and we do it according to accounting principles. I'm going to run through the accounting principles quickly, although they're not for exam purposes. So just so you understand what guides the adjustments and how they're done. But accounting principles and concepts, you would have done this at the start of your accounting journey. Most textbooks have these accounting principles and concepts right at the beginning of the textbook. Accounting concepts are basic assumptions and ideas that form the foundation of the accounting process, such as the idea a business will continue. Now, what happens is these concepts are turned into principles. So the principles are the rules and guidelines for applying accounting concepts. So they're concepts, and the concepts are made into rules by accounting principles. And who makes these guidelines? Most countries fall underneath the international framework, accounting international framework. It's called the IFRS. You can Google that if you want more information. But they set accounting principles and guidelines as they want consistency across countries. Accounting is international. So if you want to compare books with books in South Africa and books in England, these accounting principles and guidelines determine how you should keep records. So one of the principles is the principle of prudence. I'm going to run through these quickly. Prudence means you need to be conservative when you approach recording transactions. So there's fair representation or estimates should be used in reporting the numbers. Income and assets should not be overstated. Expenses and liabilities should not be understated. Right, if income and assets were overstated, you wouldn't fairly be representing your financial position and financial result. Right, materiality, what they're talking about there. Any transactions that have an effect on the decisions that management make, that transaction should be recorded. There, I just joked. Do material things matter? Yes, they do in accounting. So the principle of materiality states that all information necessary for stakeholders to make sound, informed decisions must be disclosed in the financial records. Especially big transactions, big amounts, they need to be disclosed because it will affect the decisions that are made by management. Items that will influence economic decisions can't be left out of the financial records. Right, historical costs quite simply means all items, assets need to be recorded at the original cost price. For example, the vehicle that the business owns must be recorded at the historical cost. Right, the business entity rule says that the owner's transactions need to be recorded separately from that of the business. You need to keep a separate record of business's transactions, normally done in the capital and drawings account. Right, that's the business entity rule. All personal transactions, for example, groceries bought for the owner's household use, does not go through the books of the business. Right, the going concern principle simply means that the business will be ongoing and record transactions accordingly. Right, this is more important for what we're doing right now. the matching principle. The matching principle states that all income and expenses that are earned and incurred need to be recorded in the correct period. So if you've earned income but not yet received it, you still need to record it in the current financial year. If you've paid an expense which relates to next year, you need to adjust the expense account. That's a prepaid expense. So the matching principle states that income, they're the matches, that's an I, and expenses must be matched in the correct period. So once again, if you've earned income, it needs to be recorded in the current year, and if you've incurred an expense, it needs to be recorded in the current year. If you've received income in advance, you need to make an adjustment. If you've paid an expense early, it's a prepaid expense, you need to make an adjustment. The matching principle states that income earned and expenses incurred need to be matched in the correct period. More about that later. All right, also there's some qualitative characteristics that the International Financial Reporting Standard, the IFRS, has put in place for quality control of financial records. So all information needs to be relevant, and it must be faithfully represented, honest and accurate. There's some enhancing characteristics. Obviously, your records need to be consistent so they can be compared with previous years and other industries. All your records need to be reasonably understandable to the man in the street. Timeliness, everything needs to be recorded in the correct period. Verifiability means if you gave your books to another accountant or auditor, they should arrive at the same result and financial position. So these are the principles that guide how records should be kept, and the big thing is records should be fair and consistent and honest according to these guidelines. So that is why we do adjustments. We do adjustments at the end of the year to truly reflect our financial result and our financial position according to accounting principles. Now, what is a pre-adjusted trial balance? A pre-adjusted trial balance is the 12th trial balance before it's at year end, before we do adjustments. In the pre-adjusted trial balance, you've done lots of trial balances. This is the 12th trial balance, and it's called the pre-adjusted trial balance. You have a statement of financial position section, and it looks something like this. Now, according to those principles and guidelines, this is the pre-adjusted trial balance. And if you look at all the accounts, the question is, do they truly reflect, is the value that is in, let's say, for example, vehicles, a true reflection of the value of vehicles? And you've already done depreciation. So there the answer is no. Does equipment truly reflect the value of our equipment? 17,274. No, because there's depreciation. Depreciation was the first adjustment that you've actually done. Trading inventory, is that a correct figure for trading inventory? Maybe not, because if you go count the stock, there might have been stock stolen and there would have been a stock loss. We can't show an asset with 37,398 when that is not correct. Accounts receivable, 120,000. So all our credit sales, are we going to receive 120,000? No, because we know each year, let's say 5% of the debtors are bad debts, we can't show that asset as 120,000 when we know that's not actually what's going to happen. 5% will be bad. So we're not fairly representing these numbers. And according to principles and guidelines, we must do so. So we're going to have to make adjustments. This here is the statement of financial position section, the real accounts. The owner's accounts, loan, and the assets. That is quite significant, those three categories, because assets is equal to owner's equity plus liabilities, which is actually the format of the statement of financial position. But more about that later. Now the nominal accounts section of the pre-adjusted trial balance will look like this. And we're going to have income and expenses. Now rental income, all these accounts, they might not accurately reflect what the rental income is, because I know we rent out office space for 1,000 Rand a month, and after 12 months it's only showing 11,000. So we're actually still owed rental income, and we've earned it of another 1,000, because this number should be 12,000. We need to do an adjustment. We've earned interest on fixed deposit. We know that we've earned another 1,000. I know this because in a question you will get additional information telling you more about the accounts that need to be adjusted. So the information will be given to you, and then you're going to have to adjust the accounts accordingly, according to accounting principles, those accounting principles that I just touched on, in order to fairly reflect the numbers, the correct numbers. So we will end up with the correct result, which is the profit. And remember, you taxed on the profit, so it's quite important to get to the correct profit, and then also to get to the correct financial position at the end of the year. Now these are the accounts and adjustments that we're going to come across in the next few weeks. Accrued expenses, that means owing expenses. This is important. It's a new account and it's a liability. For example, if we still owe a wage, no, let me say this again. A casual worker worked for us in December, and the casual worker needs to get paid 1,500 Rand, but we only pay them on the 1st of January. But we know the wage expense has increased. Accrued expenses means owing expenses. We will go and debit wages and credit owing expenses to truly reflect the wage account, the wage bill, as an example. Accrued income is owing income to our business. We have a fixed deposit and we've earned interest, but we have not yet received the money, as it will only reflect when our year end is December. The interest earned from this fixed deposit will only reflect in the bank statement in January, but we've earned it. So we need to do an adjustment for accrued income, owing income, because the rule says, the matching principle says, you must match income and expenses in the correct periods. So if we've earned income, we need to show it, and we'll open up an account called accrued income. Prepaid expenses. If I've paid an expense for the next financial year, we need to take it out of the expense account, for example, advertising, and we debit an account called prepaid expenses. This video only introduces these accounts. The next video we will do worked examples of transactions that result in these accounts. Income received in advance. A tenant might pay us for 14 months, but we only need to record or should record the income for 12 months. That's an example of income received in advance. We need to show 12 months of rent income. That's what income received in advance is all about. Allowance for doubtful debtors. Remember I mentioned not all debtors will pay. So we make an adjustment to, let's say, allow for 5% of debtors to be bad. So that will alter the accounts receivable amount by doing an allowance for doubtful debts. Depreciation, we've discussed plenty. Your non-current assets must reflect their fair value and therefore require depreciation. Consumable stores on hand. If we do not use an expense, the full expense, for example stationery, at the end of the year we didn't use all the stationery bought and there are still 1,000 pens that cost us R1 each, we need to show those pens as an asset, and that is called consumable, means things that can be used up. Consumable stores on hand, so it's, for example, stationery that hasn't been used. Now something that I've just brought in here, bad debts recovered. If a debtor we had written off previously comes into money, and they decide to pay us, we've written off their account in our books. We call it bad debts recovered, which is income. And if they paid us, it would be like this: debit bank, increase in assets, and we will credit bad debts recovered, increase in income, the amount. It will have nothing to do with the debtors account in the accounts receivable ledger or debtors ledger. So we're going to make adjustments for the current financial year to fairly reflect the result and position of the business. So you will be using timelines again, and we're going to make adjustments because if our financial year was from the 1st of January to the 31st of December, we only want income and expenses for that period, not outside of our financial year. We will have to make adjustments because we are reporting on the current 12 months. Also, you're going to have to make adjustments for, say, for example, vehicles. If they're overstated, you're going to have to make an adjustment for your non-current assets. We're going to draw up a statement of profit or loss and other comprehensive income. In this document, you're just going to record all your income and your expenses. So you will have your gross profit and you will have your net profit in a statement of profit or loss and other comprehensive income. And it will look like this for a sole proprietor. There's the heading. When is this done? This is done on the last day of the financial year. It's called a statement of profit or loss and other comprehensive income. This is for Calibre Education. Here you have revenue, which is sales, less the sales returns, less cost of sales gives you gross profit. Add other income. There was possibly interest income from a fixed deposit. That gives the gross income. Less other expenses and interest expense, for example, interest on loan, and you will eventually get the profit or loss for the year. Interest income and interest expense are shown in notes to the financial statement. They will show you how that 50,000 was derived and how that 34,000. By accounting law, interest must be shown separately or in a note how it is calculated and separately. Right, a statement of financial position shows the financial position of the business. And if we have a look here, like I mentioned earlier, first of all, the statement of financial position is done as at or on the last day of the financial year. You got your assets, non-current, and your current assets. Assets equals owner's equity plus liabilities. And their assets, 470,000. Owner's equity and liabilities, 470,000. The details of, for example, property, plant and equipment is shown in a note, how that figure was derived. Most probably it's the book value of your non-current assets, so land and buildings, equipment, vehicles, machinery. That is the book value of the PPE, the non-current assets. You got financial assets in this one, current assets made up of inventory, trade and other receivables. Then you got your owner's equity, and you've got your current liabilities. Non-current liability was a loan. So you got your assets, your owner's accounts, which is summarized in owner's equity, capital drawings, who gets the profit, the owner. So inside owner's equity will be the profit or the loss, and capital and drawings, those are the owner's accounts. Remember I said we might do a statement of owner's equity. Statement of owner's equity will be capital drawings and the profit or loss. That information will be in a statement of owner's equity. Don't forget to have fun while you're learning. This is just an introduction to adjustments. In the next videos, we're going to look at individual transactions where we need to adjust certain accounts at the end of the year to truly reflect the financial position of the business, and also before this, the financial result of the business. Cheers. See you soon.